Hi, this is MeTime Television exploring United States stocks. This video is being simulcast on our channel MyTime Television in partnership with MeJune Television. The stock we'll be analyzing today in our United States blue chip stock analysis segment is Google. This is a blue chip stock analysis segment, but honestly anyone can see it's a blue chip stock, so why analyze it? However, even among blue chip stocks, there are some companies that are still growing, some whose growth has stopped, and others that are experiencing renewed growth. When performance is reflected, the valuation also changes, so everything changes overall. These companies may seem obvious to us, but if you get to know them well, it will help you judge these companies based on data. From that perspective, for today's blue chip stock analysis segment, I've selected Google as the stock. Since there was a recent earnings announcement, it's a good time to pay close attention to how the stock price will react after this announcement. Let's also take a look at the current valuation and other related factors together. If you look at the stock price trend over the past year compared to the steady rise of the general S&P or Nasdaq indices, this stock's performance hasn't been particularly exciting. Over the past year, the stock price seemed to be climbing to a high, then suddenly dropped by about 32%. After hitting the low, it surged again, rising by around 37% from the bottom. In this period, few stocks haven't increased this much from their 52-week low. There are even more stocks that have risen by 50% or even 80%. So it seems like we've actually seen a surge at the level of the index, but right now we still haven't reached the highest point yet. So if it breaks through the highest point, there's a possibility that Google could gain more upward momentum. If you just look at the stock chart, you can see that kind of movement. At the peak, profit taking and realized gains may emerge. The question is whether it can keep rising while absorbing these with higher trading volume. In the end, it all comes down to whether this company's performance momentum is improving. Now, since you all know Google's business very well, actually, although I wrote Google in my stock analysis, the company's official English name is Alphabet. It's Alphabet, but since we know it better as Google, I wrote Google. The ticker is Google, but the official English name is Alphabet. The companies that the company is creating, just by looking at the logos, you can probably guess. There's Google, Gmail, Google Play, Play Store, and places that do things like the App Store. There's Calendar, Google Meet for video conferencing, and among these many features, there are still a lot of items that Google hasn't monetized yet. Google Analytics is like that, and Google Meet is the same. In the future, even in Meet, when you have a video conference, if multilingual support is available, I can speak in Korean and a foreigner can speak in English, but I will hear it in Korean and the American will hear what I say in English in my own voice tone. These kinds of features are actually being implemented and provided as services. It's clear that Google is making significant innovations. The efforts of this giant company to innovate are definitely evident. So among the big tech companies, I think this is a company that is undervalued enough to be neglected for a long time. So I think it's definitely worth keeping an eye on this company. This company mainly uses search engines, but these days you all use a lot of those LLMs like Generative Pre-trained Transformer Claude or Gemini, right? You're probably directly viewing or clicking on things you searched for there, rather than going to the site and searching, so the number of times you search on the actual site is gradually decreasing. So for companies like Google, advertising revenue based on search has been a very important source of income, but as this shifts to artificial intelligence search, that traffic is expected to decrease significantly. In the end, the concern was that this would undermine Google's revenue model and hold Google back. But if you look at Google, they're making a lot of efforts to overcome this by investing heavily in the field of artificial intelligence. Now, it's time for them to show some results, and it seems like the starting point for gaining recognition in the market has opened up. And if you look at search ads, Google search itself is stagnant, but areas like YouTube are seeing the advertising market continue to grow. The new Google artificial intelligence businesses they're developing, especially the integration of artificial intelligence into Google Cloud services, are showing significant growth potential. So depending on whether these areas can drive Google's growth rate higher than it is now and dispel market concerns, I think the stock price could rise significantly. The company's current valuation is lower than its actual profits. Although the stock is cheap, the market expects profits to be hurt by damage to the core business. In my opinion, a shift in perspective is needed regarding this point. I think it's become necessary now, and these changes are starting to become visible at this point. If you look at this company's earnings report for the second quarter of this year, you'll see that their R&D expenses came out to $13.8 billion. So compared to the same period last year, it grew by about 16%. This means they're investing a lot in R&D, and this is research and development expenses, which is an investment in personnel. The part we're paying close attention to is what's called capital expenditure, and this has surged by about 70% compared to the same period last year. Capital expenditure refers to investments in tangible assets and things like that. So, expanding data centers and then calculating the company's artificial intelligence services. This company announced that it invested $75 billion in those areas. And in that process, they acquired a cybersecurity startup called Wiz for $35 billion. And by integrating security into Google's overall cloud services and similar areas, they're continuously acquiring and adding necessary services to create a structure where these things have to work together. Recently, I'm not sure if this is a happening or a comedy. They recruited the chief executive officer and key researchers of the artificial intelligence coding startup Windsurf, the core team, through a non-exclusive license agreement worth $2.4 billion. Originally, OpenAI was planning to acquire Windsurf and proceed that way, but this is what we now call vibe coding, which has recently become a hot keyword, basically coding by talking. This startup specializes in creating programs just by saying what you want, and OpenAI was trying to acquire it. But in reality, all the key personnel ended up being taken by Google. While separate from the company, significant investments are being made in these areas due to the acquisition of key personnel. And there's something called the TPU, which is an artificial intelligence accelerator that Google is developing on its own. It's kind of like a GPU, but it's an artificial intelligence accelerator made by Google. Currently, this company's TPU model is optimized for artificial intelligence model training and inference. Google Cloud Service, as I mentioned earlier, is where the revenue is recorded. Through Google Cloud Service, they keep equipping TPUs and are currently running artificial intelligence services for inference and other tasks using these. So, TPUs are actually cheaper than GPUs and are very efficient, making them a highly cost-effective artificial intelligence accelerator. Google will continue to expand this area, and there is a high possibility that these aspects will also be used or sold by other companies. Because in reality, it can significantly reduce things like token usage, which means it can greatly lower costs. So when running LLMs, I think that's why they seem to have a lot of confidence in this area as well. By investing heavily in artificial intelligence startups, Google is diversifying its portfolio, which seems to be a key point of change for them. Looking at this convenience is the most important thing for Google, because their current business models are widely recognized. Is it a blue chip company? Among all American companies, 13% score 89 points, so it's an overwhelmingly top tier company. There's really nothing to analyze. What more is there to analyze about the company? That's it. What were the factors that kept this company's stock price from rising much, that held it back, and are those factors being resolved now? I think it's really important to look at this scenario or this story. If you look at it over the past year, it scored quite high, so you can consider it a top tier blue chip stock. The second quarter earnings were also very strong. Came out a few days ago, about 3 days ago. Sales reached $96.4 billion, a 13.8% increase from the previous year, with earnings per share growing by 22%. The company's performance demonstrates steady growth, and its growth engine remains robust. Despite being a giant company, it's still performing exceptionally well. The quarterly operating margin is 32.4%, and the net profit margin is 29.2%, down from 38% in the first quarter. If you look at the sharp spike in green, it shot up suddenly and then dropped back down again. Because of this part, the overall annual net profit margin this year will be higher than last year. A higher net profit margin means there's a good chance that the net profit itself will also increase. So it's important to keep an eye on these factors. Why did it go up so much and then drop again? I checked into it, and if you look here, there are a few areas in the balance sheet where things jump. Among them, if you look at the long-term investment assets here. At the point where it goes from the fourth quarter of 2024 to the first quarter of 2025, you can see that long-term investment assets jump from $37.9 billion to $51 billion. The long-term investment assets jump, and that has an impact. The income statement is what appears as a result of the impact on this balance sheet. If you want to analyze the causes in the income statement, of course, you should look at the business divisions for sales, but for other things like costs and expenses, you must look at the balance sheet. That's what has an impact there. So, what are long-term investment assets? These are investment assets that a company holds for investment purposes, intending to keep them for more than 1 year. We call these long-term investment assets. There are two main types. One is companies related to the equity method, where the company owns at least 20% and sometimes more than 50% plus one share, but usually less than 50%, and handles them using the equity method. These are companies that the company has invested in. Whether it's a listed or unlisted company, if an investor has put money into stocks with the intention of holding them for an extended period, it is considered a long-term investment even if their stake is less than 20%. So that part has increased significantly at this point. That means this part affects the income statement. So if you look at this time, this company invested in SpaceX, which is Elon Musk's company. The exact shareholding isn't specified in the 10K or 10Q, but according to market estimates, it fluctuates between about 6.5 and 7.5%. And on average, it's known in the market that they hold about 7%. So holding about 7% means they don't use the equity method for profits, but rather, if the company's stock price goes up, they record it as a valuation gain, and if the stock price goes down, they record it as a valuation loss. However, because SpaceX is privately owned, real-time daily stock prices are not available. Because there isn't one, normally when you make this kind of investment, it gets recorded as a long-term investment, and then you just keep it at the original cost. But when do you reflect it? Even private companies have events, right? For example, when they attract investment. If they attract investment, it means they're raising funds based on a set market value. Let's say I invested in this company when it was valued at $800 billion, and now they've raised new investment at a $1 trillion valuation for 10%. That means the value increased by $200 billion, right? The increase in value, proportional to my shareholding, is recognized as a valuation gain, meaning it's reflected as a non-operating profit. For unlisted stocks without significant events, they are recorded at acquisition cost. When an event occurs, it is handled accordingly. So at this time, when SpaceX received an equity investment, this event occurred and these parts were recognized as non-operating profit. If you look here, the non-operating profit on the income statement jumped from $7.6 billion to $15.9 billion in the past. This part jumped. If the next investment round has no or low valuation, there will be a loss. No loss from the investment round means no additional investment or event occurred. There's nothing to evaluate for market value, so this valuation gain, since it happens as a one-time event, won't occur again, right? So, as I mentioned earlier in this chart, it happened in that quarter. There was a part where market value could be evaluated, and since those parts didn't occur additionally in this quarter, things returned to normal. So these sharp spikes happen when those valuation gains occur. That's how you should see it. So if you look at the net profit for this year, when the operating profit increases, the net profit also gets bigger. As a result, the net profit margin goes up and the earnings per share increases as well. Then, when we predict the earnings per share for the next year, 2026 will exclude these one-time items because we don't know how much they'll be. However, this could make the growth rate appear a bit lower. This year it might look higher and next year it might look lower, but the reason the earnings per share growth rate seems low next year isn't because it's actually low, but because of these one-time items. And if, for example, SpaceX or similar companies increase in value again and there's another valuation event next year, there are areas where operating profit could rise again. You can consider it shifting due to these reasons. If you look at the cash flow, it's tremendous. About $130 billion in operating activities, plus or minus. Well, it's a minus, so it means they are growing tremendously and it's good to show it in cash. What we need to pay attention to is from 2024, if you look here, it's the gray area labeled as investing activities. This is dropping straight down at the moment. So here, below zero is negative and above is positive, and being in the negative means they're spending money in terms of cash. expenditure. In other words, the speed at which they're spending money on investment activities is getting faster and faster. So this means the company is doing something for growth. In fact, this part is now rapidly increasing as investment in tangible assets. So they're investing a lot in things like data centers, and we expect this will have an impact on future sales in areas like artificial intelligence, cloud, and cloud services. The stock price and earnings per share have increased, but the price to earnings ratio has decreased significantly in comparison. The increasing earnings per share and stagnant stock price indicate an undervalued price to earnings ratio. So, among the large companies listed in the United States recently, most of their price to earnings ratio S have gone up, but this is one of the rare cases where the price to earnings ratio has moved in the opposite direction. So I think this is the type of company where people thought the market had already finished searching, and because of that misunderstanding, the stock price was really stretched. So once that misunderstanding disappears, the price can return to its original level. If you look at the recent stock price and expected earnings, I'll be focusing on the earnings per share direction. If you look closely at this point on the chart, if you look at this chart carefully, if you look here, right here, on the right it's $10, the amount is so large. On the right it's $10 and on the left it's $200. So that's a 20 times difference. If you look at the top, it's $12 and $250, so it's almost the same. Then there are these points where the stock price and the earnings per share meet, right? These points are roughly when the price to earnings ratio is 20 times, almost 20 times below this line. The price to earnings ratio is less than 20, and above it, the price to earnings ratio is more than 20. So when we look at Google's current chart, what can we conclude? A price to earnings ratio of 20 is reasonable. Below 20 or around 15 is very cheap, while 25 is very expensive. The stock price generally moves between these high and low points, likely fluctuating within this range. So when it reaches that point later, it's better not to buy. Right now, the price has risen to about the middle range, so we can say it's a reasonable price, not an expensive one. If market misunderstandings clear up, prices can rise to a point, but stock prices never increase limitlessly. Carefully review the valuation before making your decision. If you look at the expected earnings, this year's earnings per share is expected to increase by 20%. The non-operating profit and loss is high relative to sales. It grows by 10% this year, but only 6% next year. This doesn't necessarily mean profitability is significantly worsening, considering the earlier appraisal amount. Non-operating profit and loss isn't included in 2026, causing a drop. If it happens, the value will increase again. But this part didn't go down because of that, and discovering things like this based on such data is a really important part. If you look at 2027, everything reaches 14%, so you can see that this is a company with intermediate level growth. If you look at the valuation, it's still staying at a very undervalued level, almost to a disappointing degree. Even at this time, it was very undervalued, briefly undervalued, very undervalued, and even though the stock price has gone up now, it continues to remain in a very undervalued state. So I think that if just a few of the factors holding this company back or its upward momentum are resolved, it could easily reach a price that reflects its true value. Anyway, these aspects are changing a lot right now, especially with the environment surrounding artificial intelligence and related fields. Search the news thoroughly when watching this video. Your judgment may differ depending on when you watch it. The video's relevance may change over time, so make decisions based on the most current information available.
Because of that, right now.
What I'm telling you is based on the data, using the data from our site, Choice Stock, and explaining how you can analyze and make decisions. If the data changes later, I hope this will help you make decisions according to the new information. If you look at the exponential moving average chart technical analysis, you can see that in the midterm, just after May, there was a golden cross. After that, at this point, it shifted to a midterm upward trend, entering a structure where it could gain upward momentum. That's how you can see it. Let's move to our site, take a quick look at the current situation with Google, and then wrap up. Yes, Google went up 1.6% yesterday and reached $195. On our site, a buy signal appeared on May 9th. Since the buy signal on May 9th, it's gone up about 27%. The company has an accumulated trading signal return of 129%, making it one of the most accurate. So I can't really check things like valuation, technical analysis like exponential moving average or supply and demand very well. Then in the case of Google, it might be good to refer to this buy signal. So when a sell signal appears here, it would be good to realize your profits at that time. Looking at the point when the buy signal appeared, you can see it here on the chart. Then when it seemed like it wasn't right, a sell signal appeared here, and the price actually dropped quite a bit. And the buy signal we caught was detected again at this point, and now the stock price has risen about 20% from here. So I think it would be good for you to refer to this trading experiment and make your final trading decision. You can also try it out for yourselves. Lastly, if you look at the financial statements, here is the corporate tax expense I mentioned earlier. You can see that this has increased a lot, but if you look at the operating profit here, it jumps up like this. This jump is due to the one-time gain I mentioned earlier. If you look at the assets here, the long-term investment assets also jumped up like this. So this was a one-time event that occurred because of that. I mentioned earlier that we do a lot in terms of cash flows from investing activities. If you look at the tangible assets, you can see that they've been increasing significantly recently. About 2 years ago, as of June 30th, 2023, it was $135 billion, but now it's $217 billion. So they've increased their tangible assets by about 50% in just the last 2 years. That means artificial intelligence data centers are expanding tremendously, and they're installing TPUs and accelerating artificial intelligence services through these efforts. This trend is continuing. So through this, there's a way to monetize again, and it's clear that this is an area where Google can continue to grow. The company is investing in SpaceX and other firms like Anthropic, the creator of Claude, acquiring minor stakes in each. So, whether this company can move past being a temporarily stagnant giant and grow again in the future, this point seems to be the most important when analyzing Google. If you found this video helpful, please subscribe, like, and turn on notifications. Thank you.